What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis on Dutch Bros stock. So let's get into this. First thing we have on the screen here is the stock chart the last 5 years. As you can see, there's been some volatility with the stock. It's been anywhere from $23 to $82. And right now, we are sitting somewhere in the middle at about an $8.2 billion valuation. So the main reason I wanted to make this video is because a couple weeks ago I went to a brand new Dutch Bros location by my house in Indiana, and I was not happy with it at all for a couple different reasons. Number one, they do not have regular coffee. You either have to get a cold brew or you have to get some sort of Americano drink that they have. So that was the first disappointment. So I ended up getting a cold brew. Then the problem is the cold brew was $7, which is much more expensive than other places like Dunkin' or Starbucks. And then the third problem was that it took at least 15 to 20 minutes just to get in and out of the drive-through. It's just a drive-through. So that's why I wasn't very happy with it. Then the other problem with this company right now is there's a lot of competition, especially by my house over here. We've seen just in the last couple of years, there's been a ton of new companies jumping up all over the place. So we obviously have a ton of Starbucks and Dunkins. We have what? Big B Coffee, we have Coffee Cabin, we have Seven Brew, we have Scooters, and now we have Dutch Bros. So along with all the small business coffee places nearby too. So we have a ton of these coffee places. I think like the main reason I went to Dutch Bros was just because I wanted to try it because it's something new, which at the beginning I think a lot of people are just gonna go try it because it's just for that reason. But in the long term, you have to think about how many customers are actually going to keep going here for the next couple of years. So let's take a look at their numbers. If we look at the revenue the last couple of years, they're growing so the last 5 years they were growing at 38%. The last year they only grew at 27%, which means growth is already slowing, but they are growing around 30% per year. And but I mean, look, this year they're expected to grow 25, then next year 23. So the growth is already slowing. Net income and free cash flow, I'm glad they've turned that from a negative to a positive. Now they did $80 million of profit last year, but $80 million of profit's not that much for a company at an $8.7 billion valuation. You're paying 79 times last year's earnings and 53 times this year's earnings, which is just insane. Shares outstanding still growing a lot. The last 2 years, they upped it 30% per year on average, which is crazy. That's not helping the stock out at all, which is really kind of surprising because they have positive net income and free cash flow. So why do they really need to be raising that much more money? I don't know. Free cash flow yield is very low, under 1%, not good at all. That's what makes the stock look overvalued. Price to sales is somewhere in the middle, and really a price to sales of 4 is not that bad. So I think it's just a cash flow or a profitability problem right now, and they are scaling. They are growing pretty quick. So you got to take that into consideration. But if we look at some analysis from Gemini here, we could see, okay, Dutch Bros is whatever, beverage restaurant. They have brand loyalty because of their Dutch Rewards program is very sticky, accounting for about 72% of transactions. This is not that, and it gives them a deep customer data. That's not that important because every coffee place has that. And, I use rewards in the app for a bunch of, for Starbucks and Dunkin' as well. So that's not much of a moat there. High velocity. Okay, this part is good, but there's also other places that do this. Seven Brew does this too. I think Scooters does this. There's some Starbucks where you can't even go inside. So this is nothing that different either. They are only drive-through and walk-up windows, which I could see where that makes it more profitable and it makes more sense, but it's not a moat. That's great for profitability, but it's nothing different that's going to make them stand out against competitors. Okay, what about this one? Unlike pure coffee chains, they rely on coffee only for they don't or they rely on coffee for only 50% of sales. Okay, that's not a big deal either. The other companies also have energy drinks and food and other things. Their Blue Rebel energy drink accounts for 25%. Okay, great. Attracts younger people and a strong afternoon traffic. Okay, great. Then we have right now, they have about 1,100, 1,200 locations, which is much smaller than Starbucks, which with 16,000. They achieved a record average unit volume of $2 million a shop. That's great. and it grew. Same store sales grew 7.5%. Now that's good. That's good. 5.5% jump in foot traffic, fantastic. They are aiming to do over 2,000 shops. So what? Almost a double, right? Yeah, almost a 2x in number of stores over the next 3 years. That's crazy to add 1,000. They're going to add 1,000 stores in the next 3 years. Then long-term potential of 4,000 to 7,000. Yeah, maybe. I don't think that's realistic. I don't see them becoming as big as a Dunkin' or Starbucks. So let's just say we look at the next couple of years here, right? Let's say we're talking right now they're doing under $1 of EPS. Next year's they're supposed to top $1, and then they're going to be doing about $2 in 3 years from now, right? And then maybe 2.50. But let's just say they do about let's say they do hit $2, whether it's in 2 years, 4 years, 6 years, whatever it is. They do $2 EPS, right? A fair PE on that would be like a 25. And that would put the stock at exactly where we're at right now, 50. So pretty much this stock is valued fairly based on numbers that they're going to be doing 3 to 5 years from now. Let's say about three to 4 years from now. So that's why I think the stock is overvalued. I mean, I would be paying, in other words, if you could pay 25 times today's EPS, that would make more sense. So I mean, I think the stock should be valued at about $25. And for me to buy it, I would want it at like under $20 because if I'm just gonna I think you can easily double your money in the index over the course of 5 years. So if I'm gonna put all my money into just one company instead of the index, it needs to do a lot more than a double my money in 5 years. What else do we have here? Yeah, okay. The valuation's high. It's trading at 45 to 60, and then it's saying, yeah, by 2030, when the growth slows, the P is going to be 20 to 25. So the takeaway here is that the stock is worth like 20 to $25. That is my opinion on this stock. Let me know what you guys think. I hope nobody is buying this because it is very overvalued at $50 a share. But I will see you in the next video.